Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
It's down here.
See it.
Yeah. Move it up. Move it up. Yeah, there you go.
Okay.
Hello and welcome to the Tech Talk for Tuesday, January 7th, 2020. My name is Will Pauly and I'm here with my co-host, David Blake. David, how's the new year going? You doing all right?
Good. Thanks, Will. Thanks for asking.
All right. Let's start off with a peek at what the market's been doing this past week with a look at the market letter. Can you give us a quick breakdown of what we're seeing here?
Yeah, we finally had a little bit of volatility come back into the market this last week during the last of the Santa Claus rally. We had last Monday, we had some tax selling, sent stocks lower to start the week off. And then, we saw some investors buy that dip. And I think it was the first day of trading on the new year. I think it was last Thursday. The Dow soared 333 points, up 1.16%. Heavy trading. The Dow, the S&P 500, NASDAQ, they all closed at new record highs. But then we had that killing of the Iranian general on Friday or Thursday night, I guess, over Friday, which sent stocks sharply lower again and pretty much wiped out all the gains from that last week. We ended up pretty much flat. The Dow snapped a three-week win streak. It was down about 10 points. S&P snapped its own 5 weekly gains. It was up actually about 5 points, and actually it was down. It gave up 5 points. I'm sorry. The NASDAQ actually kept going a little bit higher. It added 14 points, but technical condition was mixed last week as we wrapped it up with Friday's selling. We did have a chance for some of the overbought indicators to pull back into bullish to neutral ground. Indicators are still strong. We unfortunately we're still overbought by several measures. The S&P short range oscillator, however, it's kind of working back to more to neutral ground. But we still have things like the 14-day RSI which was above 70, 75 for some of the different indexes. It's come down to around 68, 60, 69, 67. Which is right on the edge of being overbought. As I mentioned, some of the daily commentary last week, the S&P 500 at one point, I believe it was on Tuesday or Thursday of last week, where it was 9.2% above its 50-day moving average. And you just don't get that without having some kind of a pullback. That's very stretched. Valuations are already a little bit high. So that's a pretty much of a red flag. We have had some negative divergence finally coming into the market also. And that's the underperformance of the small cap Russell 2000 and Dow Jones Transportation Index, which myself and most market technicians kind of look at as we want to see those kind of leading the market. They usually will lead the market up. They may lead it down also. So we're watching that negative divergence. We also have had we've been having bullish internal breadth. However, if you've been reading the weekly letters, while the NYSE advanced decline line has been punching out new all-time highs, the expansion of that line has been slowing. As far as the NASDAQ AD line, it hit its highest mark since October 1st, 2018, which was the last real big high of the previous year. But the last 2 weeks, we've only been seeing the AD line advance by maybe 200 points the week before and about 250 points last week. So that has slowed. It's starting to show that a lot of the smaller cap stocks are starting to slow down. They're not participating. They're not punching out new highs. They're maybe going sideways to maybe starting to pull back a little bit. And so that it indicates to me that we are probably due now for a little bit of a pullback. I was actually surprised by the muted response we got on Friday to the Iranian killing of that general. But I think people were so used to buying the dips over the last year that they moved it anyway. Now, with the valuations as high as they are, I think that it leaves room for more downside, especially if we get some kind of a little bit more rising tensions over there in the Middle East. We also have a CTI, which has moved into negative ground. Now, if you were here 2 weeks ago, I said that we had gone to a neutral in the market at the end of November. We kind of missed that run, and as it turns out, the weekly the low for the cycle we had it as pegged in August. It actually should have gone and pegged the low that we made the first week of October. That would have kept us in the market for the whole week. However, it still would be going to a sell signal as of last Friday if we had any negative versions, which we had. And we're going to stay at a negative on the market probably for about 3 weeks. Now, I've said over and over, I don't look at this as a 10-15% pullback, and that can always happen. However, I do think we can probably, first off, we can start to go back and fill the gap in on the S&P 500 from about a week and a half ago. That would take it down to 3205. We get down to that, I think my target on the downside would be about 3160 to 3183. We're only talking about maybe a 3% pullback in here, 3-4%. That's not something where you want to go out and liquidate your accounts and wait for that dip. Now, if things would pick up, a secondary target would be 3105, 3125 for the S&P 500. The Dow target is 28,150 to 28,210. I think we got down intraday somewhere around the 28,250, 300, something like that, or 400. So a little bit more to the downside is certainly in the cards. A secondary possibility on the Dow would be 27,700 to 27,840. For the Nasdaq, I think our initial downside target would be somewhere around 8770 to 8800. If we get through that, that would open the door to possibly a 8565, 8590 secondary level if selling intensifies. Again, part of this is a slowing of momentum that I'm seeing in the broader market. We're getting a little bit more volume on the down days than we are on the up days. The momentum index has gone from, I believe, about a +8 or +9, 3 or 4 weeks ago. It was a neutral +1 this last Friday, down a couple more notches. Again, I think it's probably going to go down into negative ground within the possibly even this week. So that, again, is bringing out some red flags. The last thing I want to just bring up again is although the bullish sentiment has backed off a little bit, it's still there's still not a lot of bears out there. We do have the NAIM exposure index backed off from 97% down to 87%. That shows the exposure that most hedge funds and money managers are having exposure to the market, so that they've backed off a little bit. But the percentage of bullish investment advisors jumped up to 58.9 last week. I'm not sure whether that'll come out tomorrow, but that is when you get that high, that's usually a red flag that you could things are a little bit too frothy out there. The fear and greed index that we track. That got up to 91.8. That's about as high as I've seen that since they started working that thing. So again, investor sentiment is also putting out a red flag. It just means that until we start to see some support levels or something like that break down, it just is advisable at this stage to kind of take a step back and maybe trim some hedges, some positions that are very overextended. In fact, I had a SOXL that was a triple leverage semiconductor ETF. I actually sold that today. It's getting a little bit frothy. I think 14-day RSI is up around 80 on that. So I might look for some of the semiconductors to maybe be topping out. And in fact, with today's action, where the Dow's down 100 points, 109 points, there's only about 5 or 6 components in the Dow that are up today. And as far as the sectors go, you have communication services, which is would include Google or Alphabet, Facebook. I'm not sure if Netflix is in that or not. And then you have tech because of the semiconductors, and they're up because of an upgrade by Cowen to Micron, another 1 or 2. So you have some big moves in some of the big cap semiconductors, which is really punch this thing up, I guess, to another new high. But the previous couple of days, we had some weakness with semiconductors. So the rest of the market today is still going back a little bit. And I think that the prudent thing right here would be just to kind of stay on the sidelines. If you got your positions, I'd hold on to them and just see where we go. If things start to pick up on the downside, you can always buy some TVIX or something like that just to hedge your positions, or maybe some gold or something just to be in the game. But I don't see anything to go out to start selling anything right away. I would more or less just to kind of hold on and just kind of keep an eye on your positions.
All right. Thanks, David. Let's move on to the market recap and look at some of our internal breadth indicators.
Okay, if you look in here, we'll take a look at the some of the things that I'm looking at as far as negative divergence. Let's go down here to the advanced decline line. As you can see, in the NYSE advanced decline line here on the left, it's punching out some new highs. You had that straight up, during December. Once we got the trade deal, we were picking up 3,000 and 4,000 units per week. And then over here, you can see the Nasdaq, where I'm talking about, we're getting, even though the Nasdaq's punching out new highs, you're only seeing the AD line go up, go back and forth here, adding 200 and losing 200, that type of thing. So we're not making a lot of progress on that. That is what you look for to find negative divergence. On the other side, you have the new highs versus new lows. Where we got up here, we were making 360, somewhere around that, on the Nasdaq. We got above 250, where I like to see it getting up there. You're starting to see those pull back also. You're getting down here where you're close to about 100 new highs. Not really seeing a pickup in the new lows. That's the reason for that is because we're so far off of, the market's up 28% or something like that. So you're not going to get a lot of new lows in here. It's going to be very limited. But you do want to see this negative divergence as the number of new highs coming down while the market's making new highs. That kind of shows you that less and less stocks are punching out those new highs. So it's less participation making in there. Now also something else over here. Despite even with the Iran thing the other day, you barely had this thing go above 15 in the morning, and then it came right back down. I think we're at 13 a quarter right now. So you're hanging out here around this 12 level. I think I think if we get some kind of retaliation with Iran, you could probably see this thing spike up to the 18, 19, 20 level. That might give you a little bit, might see some buying coming in on that. And again, that's what I'm looking at as far as the negative divergence that's showing up in the market.
All right, so market had just moved to a bearish market posture this past week. What can you tell us about that and what it means for us going forward?
Again, the CTI, we were off on that. It's not an exact science, but what it does is, of course, it measures cycles in the market that we found exist. And we would have stayed. I had the thing called the wrong bottom, and when you have the CTI, you're always adjusting it back and forth to make sure you found the right bottoms and the right tops on these things. But as it is, we went in. We took the bottom from August, where we should have extended those cycles a little bit, made them a little bit longer out to October, and that would have kept us long in December. But as of right now, the cycles, the periods are coming up where they're getting basically extended, where we could start to see a rollover of the current cycles that we're in. But I'm only seeing the CTI be negative probably for about another 2 or 3 weeks, and that's one other reason why I think we only see maybe a 3-4% pull back in here. We start fourth quarter earnings reports start to come out, I believe, next week. We've had 4 quarters of negative earnings. What are we going to get for the fourth quarter? Well, right now they're calling for flat, but I think you're probably going to see some of that. I think you'll see many upside surprises to that. But what we're going to listen for is to see whether we're going to start to return back to positive earnings the first quarter of 2020. That looks like a good possibility at this stage. But again, until we start to see get some more reports come in, it may be a little bit iffy. I don't think we have a catalyst at this point for the market just to keep melting up and keep punching on new highs. So, I would be cautious here, neutral to lower prices for the major averages over the next, say, 2 or 3 weeks. You could get those big dips if Iran comes back and escalates the tension over there, the conflict. But while we're up here at new highs, that's sometimes when you want to be cautious, especially as we've had such a straight up run since the end of October.
All right, well, that's all we have for you this week. Remember, if you have a question you'd like answered on the next Tuesday Tech Talk, you can email it into support@marketedge.com or ask one of our live chat representatives to pass your question along to us from the next Tuesday Tech Talk. Thank you for tuning in, and we'll see you next week.